Welcome to the daily update, where I'll go over the action in the market for Wednesday, December 13th, and then we'll see how things look for Thursday, December 14th. We had a pretty significant update. The market feels like maybe now, finally, after almost 2 years of this game playing back and forth, that it finally has some kind of a Fed narrative that is at least acknowledging the idea that rates may be cut into the future. When I did the video yesterday, the idea that the rate cuts were going to start in March, that had pretty much been taken off the table. Now it's back on the table again, and some of the market is even anticipating that there could be a rate cut in March. Most likely, if there is one, maybe in June. The Fed came out and said, well, instead of maybe 2 rate cuts in 2024, we might end up making 3. Well, the market took all that, really liked it, really shot higher. Unfortunately, we're even more extremely overbought now than we were before. We've been overbought now for a number of weeks. This really pushed things up to a pretty high level. And you have to wonder, is there some kind of a blow off top that may either happen or be getting ready to happen? These things are not really that easy to pick out at the time. We kind of have to see them in retrospect. But I'm not saying that the market's going to just tank from here, that we're done going up and we're going to go down. But just keep that in the back of your mind, that we're getting a little of that irrational exuberance going again right now. We've got a big report coming out on Thursday with retail sales. Depending on how that comes out, we'll have to see how the market ends up reacting. But it's like there was a buildup to what we saw on Wednesday. The market really liked that. But now, is the party going to get a little too crazy at this point? But it could still go on for a while. So let's go back and talk about what happened. Right at the open, we had a higher open and prices climbed up to R1 at 46.56. Then we fell back down to the unchanged level. And that's fairly common. Typically, what we would see during Fed announcement days is the market would have some kind of a slight positive bias. That seemed to change over the last couple of years. Well, we went up at the beginning, came back down, just kind of settled down for a little bit. And then the Fed came out with their announcement. And then prices immediately went right back up to R1. We went up to R2 at 46.68. We even got up to R3. We went over 4,700. R3 was at 47.04, and we closed slightly above R3. So we closed pretty much at the high. We were up 1.37% on above average volume. And the technicals, we are positive. If you just look at the charts, everything just looks really good right now, but we're looking extreme. That's why we use oscillators. That's why we use support and resistance, because we're bumping into some areas that could end up producing some problems. Now, if we can break through that and keep going, okay, fine. But to keep going in this full blast movement that we've been seeing, that didn't take very much in Wednesday's session to really push us there, because we were already almost there to begin with. It's like there has to be some kind of an exhaustion point at some point going forward from here. But it's about inflation, interest rates. The market is pretty pleased. It seems like the Fed is a little more pleased with where inflation is at. So the market is more comfortable with where interest rates are at, and they're starting to drop slightly without necessarily compromising growth. So now, after this meeting, we'll have to see. You've got the Federal Open Mouth Committee. They're going to want to come out and make their case in front of the cameras and get some attention. What are they going to say? Are they going to be more hawkish or more dovish? It seems as of right now that the hawk is shifting more over to a dovish stance. So we'll just see if anything comes in to rain on that parade. We also want to keep an eye on things happening geopolitically. Yeah, it's kind of escaping the main news cycle right now, but it's still going on. We also have a war going on between Russia and Ukraine. Either one of those, or something even completely different, can always come flying in as folks are more distracted. As we're getting closer to Christmas and we're going throughout the holiday season, there tends to be a lot of things that happen under the surface, either financially or geopolitically or governmentally, that escapes a lot of the radar. And then when people wake up after the first of the year, they get finished with their hangover. They're like, oh my gosh, things aren't really as rosy as we thought. Now, it may be different this time, but we just want to, the way I look at things is, yeah, we're positive, but we also want to be prepared at the same time to at least be open to what are some negative things out there. And then what are some things that are going to slip the market back into chopping more or less sideways? Okay, now what are some comments that we can make? We did get above 4,700 with the S&P 500. The FOMC did leave rates unchanged. I have another slide to go through a little bit more of the points there. We did see a broad advance. It's like everything just ended up going higher in Wednesday's session. Wondering, are we getting close to a blow off top? That may not even end up happening. We just want to be aware of that, where everybody, you've got FOMO going on. People are afraid they're going to miss out and they're just going to start throwing money into the market. And you've got people that don't really know what they're doing that are suddenly going to get active. And that is quite often the point where things can turn a little bit dangerous. Looking at our short-term list, we have a long list of overbought or extreme positive indicators. Now, a lot of these have been on here for a number of days. The short-term ADX, the advanced decline ratio, that's a new one. The blue line is now looking extreme. The force index, it had been off there. It actually was showing some weakness. Now it's back to looking extreme. The McClellan oscillator for the S&P 500, the 20-period exponential moving average study, the Stochk RSI, Williams percent R, CCI 14 and 20 in stochastics. Those have been pretty much constant on the list. We're still watching the PMO oscillator, the RSI based on 9 periods, and the boom indicator based on 20 periods. And our list in the intermediate term is getting quite long now. We also have the ADX, the 50-period exponential moving average study, the standard deviations chart, the Erin, the PMO studies, the Chaikin money flow, the Sean trend meter, the Chaikin oscillator, the balance of power, the CMB composite, the Connors RSI, the bullish percent index for the S&P and the NASDAQ 100, the RSI 14, the percent B. We spent 2 days now above that upper Bollinger Band. The boom indicator based on 50 periods, the ultimate oscillator, that's a new addition, the new high, new low study for the S&P based on 10 periods, and now the 19-period exponential moving average of the advanced decline ratio. This is a long list, a longer list than what we've seen in quite some time. We even have a couple of things on our long-term list, the 150-period and 200-period moving average study. And I have charts to show you of all of these things. Okay, so this scenario, yeah, it may have shifted more friendly now, but how long is it going to stay that way? The Fed is, for right now anyway, keeping rates higher for longer. They didn't raise rates, but they didn't lower rates. They're keeping them at the same level for the time being. Are they done raising rates? Are they going to start to consider cutting rates? Are we back to looking at March as possibly being a rate cut time? That was gone. Now it's back, and it can quickly go away again if things really start to change. And then geopolitically, Israel, oil, earnings. Then the dollar was down and interest rates were down, and that's very common. If we really continue to go up and interest rates keep going down, that's probably going to be at the dollar's expense. That means it's going to drop down, but that tends to be more positive for stocks. We still have our two yield curves that are really important that remain inverted. The 10 to the 2-year and the 10 to the 3-month. Sentiment, it only ticked up one. We're not really extreme. This is one of the few areas where we're not getting an extreme positive reading. We get that when we hit 75 and above. We came in at 69 where we had been at 68. Our trend is positive. The ADX, both in the intermediate term and the short term, are looking very extreme right now. Our bias and momentum continue to be positive. So the FOMC notes, these are just some things that I picked out of what happened here. The committee did vote unanimously to leave the target rate unchanged, and we're at 5.25 to 5.5. Then there's this report that comes out called the Summary of Economic Projections. And this is what the market looked into and liked and really used to justify itself going higher. They are seeing improved growth outlook for 2023 and then going into 2024. We're still dealing with GDP and final issues of that for this particular year. They've also lowered their inflation outlook for not only 2023, but going into 2024. The market really liked that. And then the median estimate for 3 rate cuts in 2024 versus having 2 rate cuts. So an additional one. And the market really liked what it read in this report. Fed Chair Powell then came out in his press conference and said that the FOMC did discuss when it will be appropriate to begin dialing back its policy restraint. We haven't heard that in a long time. The market's been trying to read that in, but this is the first time when we actually heard this from the Fed itself. All right, the reports that came out. We had the weekly MBA mortgage applications index. It came in up 7.4% from the previous week. Last week, it was up 2.8%. PPI, and this was seen as friendly. This is why the market took off right after the open. It came in unchanged, where they expected it to be up 0.1%. Last time it was down 0.4%. The core PPI was also unchanged, where they expected it to be up 0.2%. Last time it was unchanged. Now, and I should have changed this. This is incorrect. I got this from the briefing.com email. We're up at about the 4.03 level or so, but we're getting kind of close now, down to this 4.02 level that RenMac considers to be, when we're below that level, that helps companies grow better with their earnings. Here are some charts showing the MBA mortgage applications really went up. Apparently, they're feeling the Christmas mood here. Here's the final demand for PPI on a year-over-year basis, where we're going down with the blue line. That's total. So it is declining, and that's what the market likes. And we look at the core, and that's also coming down and starting to drop below 2% on a year-over-year basis. Then when we look at the final demand with goods, that's starting to come down, where services are also coming down as well. And we're actually dropping below 0 here with the goods demand. Intermediate term goods, year over year, we're just a little bit below 0 with the processed goods. We're showing some improvement with the unprocessed goods, but they're still negative. Here's our charts for PPI showing the year over year change and the month over month change, where we are going back up just slightly year over year. We were down negative. We're still negative now in the month over month, but we did show a little bit of a bounce. Here's the core PPI, which is continuing to decline, where we saw a little bit of a bounce out of the month over month change. Then looking at flexible, which means inflation that can change all the time, prices are going up and down all the time, versus sticky prices. Those are prices that tend to stay the same pretty much all the time. We're seeing the blue line really coming down and coming pretty close down to this black line. And we're also seeing sticky prices, the things that don't change that much, they're starting to also come down as well. So this is looking more friendly. Then and I'll stop showing this in the daily videos after this time. This is looking out to the January 31st meeting, where there's a 20.7% chance that the Fed's going to cut rates at that meeting, but still 79.3% say that we're going to end up keeping rates the same. This is going to change every day. And this is where we're at right now, where most are still thinking that we're going to leave rates at the same rate. But this is starting to pick up. See this dark blue that really spiked up after the Fed came out yesterday and then made their announcements and everything. So a lot more people are getting optimistic about that. There's still a few folks that think that rates might be raised, and even some real outliers that think it may be raised even more. Here's our chart, where we did have a higher open after the PPI came out. We got up to R1, and then we just drifted back down to the unchanged level, and the market was just laying in wait at this point. And then right after that, boom, we shot back up above R1, R2. We got up to R3. We did hit resistance at this level, fell back a little bit, but going into the close, we actually closed a little bit above R3. Here's the 1 minute chart that I like to bring up when things really happen like this. This just shows how the open ended up going up and then coming back down, but then how things just shot right up. We got up to almost the 47.10 level before falling back, but then we saw some more buying going into the close. Here's the intraday chart, where we were kind of flat. We were looking positive, but flat before the report came out. And you see that not only the PPI report, but then the market stays pretty quiet because of the FOMC meeting, and things were pretty subdued and then just took off to the races, and we're actually up about 0.4% in the initial overnight session. Now, this is many hours before the market can open. We have retail sales coming out, and that can always change. When we look at growth of value, this is one area that has been a concern all along. We're not seeing growth really leading the way. They're both up, both the red line and the blue line did advance, but growth is not outperforming value. And when we look at this chart, the S&P growth to value ratio, we actually declined in Wednesday's session, not really suggesting an awful lot of strength, at least from a growth perspective. You could switch that around and turn it more positive, saying, well, okay, some of the value areas are seeing a little bit more of an improvement, and that's just suggesting that there's more of a broad market participation. Then on a one-day basis, we might have overdone it. This is just a one day from Tuesday to Wednesday, the advanced decline ratio. Sometimes when we spike up, it doesn't mean that we bottomed or topped or anything. It just means that we probably went up a little too far, too fast. Here's our end of day charts where everything was up, but growth did underperform value for the large caps. It was up strong for the mid caps, but underperformed value. And it was about the same, but a little bit less when we look at small cap growth to small cap value. Then the middle area, these are the ETFs that you can track to go along with that. I like to point that out from time to time. But this is an area that we're just not seeing a lot of real strength right now. We actually declined with the growth to value ratio, looking at the S&P on the end of day chart, where we're just really going up with the S&P, we're going down with the growth to value ratio. Not necessarily suggesting an awful lot of under the surface strength right now. Then looking at our trend, we're just going to the moon right now with our intermediate term ADX. It's going up. It's actually going faster to the upside and not really showing any signs of rolling over yet. And even the green line now in the intermediate term has crossed above 40. That is pretty extreme. And the red line continues to go down. Intermediate term, we're still just off to the races here with our short-term ADX, and the green line is back above 40. We did pick up with volume because people were just kind of sitting around waiting and then decided to jump in. So we did see a pretty healthy move up in volume. Here's sentiment. I shifted the circle down a little bit. Are we going to be able to maintain this positive seasonality in spite of being very, very overbought right now? The Ulcer Index is pretty much flatlining near the bottom, again, suggesting there's just not a lot of fear. We're getting down to a really low reading with the VIX. Even though we ticked up on a closing basis, we're coming down as well with the bar chart in addition to that. And I don't know if this is some kind of crazy data. Maybe this will get fixed. But when we look at the VIX of the VIX, we are declining both with the bar chart and the line chart. This is interesting. How come on a huge update, you've got the equity put call ratio spiking to a real high level? Are folks starting to hedge? Are folks that really know what's going on? Are they waiting till we get to these high levels and then buying puts to protect things if we start to fall from here? We'll have to see. But what that's done is that's turned our 5-period simple moving average back up. We had come down and almost had become extreme. Now we're starting to go back up. Is this little tick down here to the red line, is that going to be as far as we go? Or are we going to get under control here a little bit and see the 5-period start to go back down? Longer term, we also are showing a real bounce up, just to give you some idea in a bigger perspective of how this indicator can move. We did really decline with this one fear gauge that we follow, and we also are declining with the other fear gauge. It's like everybody's happy right now. There's a lot of Christmas cheer to spread amongst us, and that's when we start to get a little bit nervous, but we're not seeing sentiment necessarily extreme. We did see some improvement here with our risk on to risk off ratio. Okay, so that's good. And our advanced decline line, we're looking pretty healthy based on price as well as volume. We just saw a real spike up in new highs because we broke out from where we had been for quite a while. We're still flat with the 5-period, but we're going up with the 10-period moving average. We're getting extreme with the short-term advanced decline line ratio here. We're not extreme with the red line. That's based on 39 periods. They're both positive, but this is pretty extreme in the short term. The accumulation distribution is showing a real advance now. and the chicken money flow. You could also make a case we're getting to an extreme reading here, but it is also positive. We saw a real move up in the cumulative advanced decline line for the NYSE, also a big move up with our regular advanced decline line for the NYSE, also an improvement with the other measure of the advanced decline line for the NYSE. And we're breaking out again here. I'm seeing this as a positive divergence, at least for right now. We're breaking out based on volume with the common stock for the NYSE, where we have not quite broken out above this previous high based on price. And that can typically be healthy when volume tends to lead price higher. When we look at our advanced decline line studies, we're showing a lot of improvement with the NYSE common stock, the S&P, the mid caps, and the small caps. Everything pretty much went along for the ride. And that's when we start getting at least a little suspicious of things. In the short term, we're finally breaking out above this resistance line right here. I put another trend line down here. We were kind of dancing along that for quite a while. Now we're up to this other pivot level. Is this going to provide some kind of overhead resistance? But right now, things are showing a lot of improvement. On the bottom, we see where volume really picked up above average. We're getting extreme with our 20, 50, and we're even getting close a little bit with our 200 period moving average study. The boom indicator on 20 periods, we're getting extreme. We're getting extreme with the 50. We're still looking positive with the 200. The Stoke RSI is extreme positive. The Williams percent R is extreme positive. The CCI 14 and 20. And the force index came all the way up to the Keltner band here. So it really moved up quickly. And we're extreme across the board in the short, intermediate, and long term with our stochastics charts. And we're well above this +3 standard deviation as we're moving up higher pretty quickly, because we were going sideways for so long, and now we have up over 1% move, and it just makes our indicators just kind of freak out a little bit. Intermediate term, we're starting to get extreme even more with the balance of power. The go-no-go system, when we look at this based on a trend, that's still positive. We're really breaking out with the highest high value. We're starting to turn back up a little bit with the TTM squeeze. This is more intermediate term, and we want to see this continue to go up to turn a little bit more positive. The CMB composite is breaking above the black line. That's extreme positive. The Connors RSI is getting extreme positive. And we're starting to turn back up with the ease of movement. This tries to measure the path of least resistance, and right now that appears to be up. We're looking a little extreme still with our rune indicator. Now the green line is on top. That means that the buyers are in control. Sellers are decreasing. That's the red line here, and the oscillator is the difference between the two. The shorter term McClellan oscillator for the S&P, we're starting to get extreme positive, and we've been up in this area not so long ago. Then when we look at the summation index based on price, we're now starting to break out above these previous highs. We're also breaking out based on volume. So we're looking good on a trending basis. We're also moving higher with the NYSE summation index based on price and volume. The Swenlin trading oscillator is going up based on price and volume. And we're turning back up now with the PMO. We're also advancing based on price and volume. We're getting extreme with the PMOs that are rising, the buy signals, and the PMOs that are above zero. So all of these different studies are now extreme positive. And with the Elder Impulse system, it's no surprise that we have a green bar for the S&P. We're also positive with the parabolic SAR system. The slope is starting to turn back up. Hasn't quite crossed its moving average yet, but this is showing some improvement. Also, the MACD is starting to turn back more positive. So when we look at our oscillators, we are showing some improvement with the slope, the TSI, but look, it's extreme here. We're turning back up with the MACD. You could also suggest we're looking rather extreme. The PMO is going up and also coming back to a previous high here. Turning back up with the PPO, we're pretty much flat with the tricks, and we're still negative with the KST. So we're getting a bit of a mixed picture here longer term. But in the short term, we're looking pretty extended where we are improving and looking extreme in the intermediate term. We're above all the plotted moving averages that we follow. And the BPI, the bullish percent index, is continuing to go up. It could still go up further than this, but there's other times when this has ended up topping out. We're also going up with the NYSE bullish percent index. This is turning more positive, And we're extreme positive, coming back to a really high reading for the NASDAQ 100 bullish percent index. And remember that there are NASDAQ 100 stocks that are also in the S&P 500 index as well. So if the NASDAQ one, that's why we watch the NASDAQ 100. If it starts running into trouble, that often bleeds over into the S&P 500. The Sean trend meter is coming up to this blue line, looking extreme positive. The Chaikin oscillator, man, we just jetted above the green line here. We haven't seen that since the big move up back in 2022. So this is looking extreme. The money flow, though, it's still positive and above 50. The ultimate oscillator starting to get extreme positive. The vortex turning back up with the green line. The percent B, we spent 2 days now above the upper Bollinger Band, so we're looking quite extreme with this indicator. We're looking extreme with the RSI 14 as well as the 9 period. It's not an official overbought signal for any of these charts until we turn and cross back down below this level. On-balance volume continues to be positive. And here's one we haven't shown in a while, the rate of change going back 50 periods. We're starting to look extreme. Now, other times when we got to this, it didn't necessarily mean that we turned right at that point, but sometimes we do have a tendency to slow down at least. Then looking at our 250 period moving average study, we're starting to come back up to these previous levels on the 200 period moving average study, and we're breaking out just a little bit from this previous high when we look at the 50 period moving average study. I don't have any Fibonacci charts because we're in no man's land with all of the charts that we follow, but looking at our trend line study, we are breaking further above this previous high. When you just look at the chart, yeah, things are looking a lot better right now. On a trend basis, we're also positive with the Heiken Ashi. With the Kegi is really starting to break out. The Renko is positive, and the 3-line break is also positive. And we had a couple of new X's drawn in here for the point and figure chart. We still have the same signal that was generated on November 20th, which was a double top breakout, but we're seeing more X's being drawn. We're actually breaking out and doing what this signal was thinking was happening. And then some long-term charts, we're getting extreme with our 150 and 200 period moving average studies. And then this is a weekly chart because we came right up to this level in July, and that's where we hit overhead resistance and then fell back. We've been able to break through that longer-term resistance level now. So that's positive in and of itself. The Zohorchak method, now there's a 1-day lag on this. This won't have Wednesday's results until tomorrow because it's the next day, next business day is when this is actually calculated. That's NBD. Then we're starting to break above this longer term resistance line. This is a weekly chart of the S&P 500 going back to the 1987 crash. So we came back up here before and then we fell back. Are we going to be able to stay above it this time? And then we're also keeping an eye on the weekly chart for the NASDAQ 100. This goes back to 2009, where we're coming right up to the underside of this long-term trend line. Our indexes, we're seeing a lot of improvement with the equal weight. It's starting to pretty much perform about the same as the regular S&P 500. Our ratio is going down a little bit as we're seeing a little bit more improvement in the broad market. We're breaking out with the Dow, but we're just kind of lagging right now. This is another warning sign with the transports. We did get beyond this previous shorter term high here, but we're not breaking out the way the Dow is. And even utilities took part in the advance in Wednesday's session. But the transports are still underperforming the Dow in a more positive environment. When we're seeing more sustained growth, we want to see okay, let me back that up. When we see more sustained advances, we want to see growth doing better and we want to see the transports doing better. And those are two areas that are lagging right now. The Dow is really looking pretty good now and came up above this R1 level. The diamonds are positive for the Elder's Impulse system, and we're coming up to the underside of this R1 for the NASDAQ. Is this going to provide some overhead resistance? But the NASDAQ 100 is already up at this R1 level. It hasn't closed above that yet. Can it get above this? Is this going to be a problem here? But we're still positive on a trending basis for the Qs when we look at the Elder's Impulse system. We're turning back positive with the PPO. This is a momentum oscillator for the NASDAQ 100. And longer term, we're coming back to this previous high here. This is an anchored moving average, and that's why I started showing this chart. But if you look at the price where we're at over on the right and the high that we were at back in 2021, we're right back up to this level. This is longer term. Are we going to be able to break above that, or is this going to present some kind of a problem? The small caps, yeah, hey, maybe they're getting a little bit of love right now. They came right up to the R2 level. Can they get above that? They're still in a longer term downtrend, though. We want to see a golden cross here that just hasn't happened yet. And we're getting extreme with the Russell 2000 when we look at the RSI. We broke above this resistance level that really had been causing some shorter term problems here. We still have a longer term downtrend, but on the MACD is still positive, but we're getting kind of to an extreme reading here. We are positive with the Elder's Impulse system with the small caps. The mid caps were able to break above R1. We're not quite up to R2 yet, also working off of a downtrend. And we're positive with the Elder's Impulse system for the mid caps. The financial sector, it was up. It's been seeing some more strength as of late. And the bank ETF, we have seen a recent golden cross here. After the really difficult time that the bank ETF had, it's now starting to turn back and look more positive. The micro caps also had a good day. They're up almost to actually a little bit over the 110 level. The FANG index is breaking out, so that's looking good. See, everybody's just happy. It's like the good times will never end. That's the problem, and that's one of the things that I teach in my classes. People think that the way things are right now is the way they're always going to be, but the market is beyond bipolar. It can be just exuberant one day and suicidal the next with depression. So we just want to be aware of that. I'm not saying that's what's going to happen. We just want to be prepared for these things. Where the FANG index is continuing to break out and setting new all-time highs. The dollar continues to go down a little bit, but it's still on a longer-term uptrend. And then bonds, and I have some additional charts to show you here. We really shot down to the 200-day moving average with the 10-year yield, and we came up and broke above the 200-day moving average based on price for the 10-year ETF. The 1 to 3 month, that one, I'm not quite sure what to make of this. We're still getting a positive result when we take the 1 month yield and subtract the 3 month yield. It usually doesn't stay like this for very long. Is there some kind of a warning? Is there something that we're not seeing that is happening, because this is not normal? Now, looking at the broad market as measured by the S&P 1500 to shorter term bonds, we're coming back and starting to break out in this ratio and showing a lot of improvement here. Here's another broad market measure with further out bonds. Also, we're starting to break out to the upside. The tech sector is breaking out when compared to 3 to 7 year bonds. And when we compare cash to the 3 to 7 year bond, this is continuing to go down. That's because folks are feeling more confident about interest rates, and this ratio goes down when that happens. When we look at shorter term bonds and compare them with further out bonds, we are seeing this really declining, and that's suggesting a more interest rate friendly environment. Here's the opposite of that. When we take further out bonds and do a ratio with shorter term bonds, this is really starting to go up. Folks are starting to lock in longer term rates, thinking that maybe they're topping out or close to topping out. So they want to lock those in for 7 to 10 years, thinking that short-term rates are just going to continue to go down, and even longer-term rates are going to start to go down. We look at the Qs to the 3 to 7 year bond ETF, we are breaking out and showing a lot of improvement there. When we look at the S&P to the 3 to 7 year bond ETF, we are also breaking out, suggesting that we might end up seeing a soft landing. Home construction, very, very sensitive to interest rates, breaking out when compared to bonds. And then an update of a few charts here. I'm not showing the growth to value ratios now because they're really just not helping us all that much. We're still extreme with the 10-day average of the S&P 500 highs minus the lows. And this is the 19-day exponential moving average of the advanced decline ratio. We're getting extreme based on price, and we're just barely extreme based on volume. Broader, when we look at the broader market with the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows, we continue to be above zero. This is suggesting that the broader market is showing improvement. And when we look at the 50-period moving average of the new highs, new lows for the S&P, we continue to go up. But when you look at the indicator, We're going above this 80 level now, which it could still go higher than this, but this is an extreme positive reading. I think I put that one on the list. We are declining with the 2-year yield, which has been giving support to the S&P. So what's our outlook for Thursday? Please be reminded that the European Central Bank will be meeting on Thursday. They'll get done and all this will get baked into what they say before the market even opens in Thursday's session in the US. We're still dealing with earnings season, and then we're still dealing with all the different geopolitical events. We're still overbought, but we're positive when we look at our technicals and we are breaking out of the range. We're wondering, is some kind of a blow off top going to happen? We will get the weekly jobless claims, retail sales. That's a big part of the U.S. economy, and that's going to be coming out before the open. Import and export prices, as well as business inventories, and then watching all the geopolitical events. So on Friday, we will get industrial production and capacity utilization. That will give us some kind of a heads up as to what's happening more in the manufacturing area. Seasonally, we are dealing with quadruple witching week. That's the week we're in right now, where we're up 69% of the time. We're down 31% of the time. Looking at December 14th, we're neutral to positive with the Dow, where we're neutral to negative with the S&P. We're back to neutral to positive with the NASDAQ. So nothing real strong seasonally when we just look at the years 2001 to 2021. But we might be starting to see this January effect where the small caps are outperforming the large caps, at least. But we've seen something like this before. The small caps have a really good update, and even the mid caps do well, and then they chop sideways, or they end up giving a lot of that back over the next couple of days. Be aware of that. Just be keeping an eye on that if you're more interested in those areas. We will be on the 10th trading day of the month, where we're not really seeing anything all that positive seasonally during a pre-election year. And based on Carson, they see us going into a little bit of weakness before things tend to turn more positive going into the latter part of December. Wednesday does end up being the most negative day of the week. And we're wondering, are we going to see the continued positive seasonality during a pre-election year? We also see positive seasonality with this chart, as well as this next chart and the next chart, and with the Carson chart, and with the equity clock chart. We didn't really see this downward move yet, but we're coming more into the middle part of December now, where we do tend to see more positive seasonality. But when we look at the Stock Traders Almanac, we do see things looking better for the NASDAQ and also looking better for the S&P. Now, it may not turn out this way. We're just looking at what has historically happened before. So our scenarios, we're not going with the down one right now, even though we are very overbought, even though we may be getting at or near a possible blow off top, but there's no evidence of that yet, other than we're hitting resistance. We're not seeing any of our charts really confirm that. So if anything, we're still going with the up scenario. Be careful though. We are very extended to the upside with both the short and intermediate term ADX. That measures our trend, and it's getting pretty excessive right now. So the warning signs: growth is not participating, at least very much, in the advance that we've been seeing. That's a warning sign. I didn't put it on the list, but we're also concerned about the transports not really participating. The risk on posture has been showing longer term weakness, but the last couple of days it's been improving. The equity put call ratio is now going back up. Is there excessive hedging going on? Are there folks that are really worried about this big move that we saw and they want to lock in those profits? Momentum oscillators, we're looking more positive. We are improving, but we are still seeing a mixed picture there. The Coppet curve is still negative, and the Russell small cap and mid caps continue to be in downtrends. The positive signs: the daily special K chart is positive. The longer term equity put call ratio is still going down. Our oscillators are improving, but they are mixed, especially in the long term. The parabolic SAR and the vortex chart are positive. The bullish percent index is positive, but it's now going above 70, so it's starting to look extreme. The Zohorchak method, we'll have to see if anything changes on that when we get the updated chart there. But for right now, it's neutral after having been more negative. And the growth that we're following for the small and mid caps, it's just chopping sideways. It's not really participating either. The financial sector, though, has been really showing some real improvement. And our longer-term 50-period exponential moving average study of the new highs and new lows continues to be positive. So our conclusion, we're positive, we're overbought, we are breaking out, but is there some kind of a blow off top? Now, I'm not trying to be a doom and gloomer here. I'm trying to be a realist with this. When we see everything moving in the same direction at the same time, that's when we don't necessarily do anything, but we just want to be mentally and emotionally and even financially prepared for that. In the short term, we're overbought. We are positive, though. And in the intermediate term, we're getting really extreme. That list is pretty long. And we're even getting a little bit overbought in the long term with our moving average studies. So thank you. Have a really good day. I hope you found this video helpful, and I will talk to you in the next video.